What if I told you a single ETF, one you've probably never owned, turned a $1,000 investment into over $1,519 in just 12 months? That's a 50.93% return. Without chasing meme stocks, without jumping in and out of trades, and with zero reliance on hype. Sounds insane, right? But it's not. It's just math, and the result of a system built for what's happening right now in the market. The conflict we're about to unpack is simple: structure versus chaos. Most portfolios break because they're fragile, scattered, reactive. But there's a quiet shift underway, not just in tech, not just in finance, but in how the market fundamentally operates. The stakes? Massive. Because artificial intelligence isn't coming. It's here. And it's not just powering new startups, it's becoming the operating system for healthcare, defense, energy, and even the way you shop online. Let's bring some proof to the table. In 2023, global AI investment hit $200 billion, and according to PwC, AI is expected to add $15.7 trillion to the global economy by 2030, more than the current GDP of China. Meanwhile, traditional portfolios built around energy, industrials, and utilities, they underperformed the NASDAQ by over 34% last year. That's not a cycle. That's a rewrite of the economy. This video isn't about guesswork or hot picks. I'm going to show you 5 ETFs that I've personally stacked to grow my portfolio, and they've returned anywhere from 17% to 51% in the past year. And no, we're not just listing tickers, I'll walk you through the actual structure, the math, and the logic behind this system. So if you're still investing like it's 2012, this might be the wake-up call you didn't know you needed. Ready to build structure while everyone else chases chaos? Let's break down the method. I call it the Basket First plus 5 Moat Satellites trademark blueprint. This isn't a random collection of ETFs. It's a system. Think of it like a tree. At the center, you have the trunk, a broad, low-cost growth ETF like SCHG. That's your foundation. Then, branching off, you add focused satellite ETFs, each with a clear purpose: technology, chips, AI velocity, and precision targeting. Now here's why this matters. Most investors treat ETFs like filler. They sprinkle a few into their portfolio for diversification. But that's not leverage. That's laziness. The truth? When used strategically, ETF overlap isn't duplication. It's reinforcement. You're not repeating exposure. You're weighting conviction, stacking smart, not wide. Let's look at some real data. According to Morningstar, portfolios built primarily from individual tech stocks have seen volatility spikes over 28% in the past 5 years, especially during earnings seasons or rate hikes. Compare that to blended ETF strategies, particularly large cap growth plus sector tilt, where volatility stays under 17% on average. That's not just smoother returns, it's durability. And here's a teaser for what's coming. One of the ETFs I'll show you has returned 3 times the S&P 500's performance over the past 12 months. That's not a fluke. It's what happens when you stop spreading and start stacking. Stick around. The real building begins next. Start with the core. SCHG, the Schwab US Large Cap Growth ETF. If your portfolio is all sizzle and no structure, this is where things start to stabilize. Here's the problem. Most growth portfolios crumble under the weight of hype. They chase earnings rumors, hot sectors, or random analyst upgrades. That's not investing. That's playing portfolio roulette. What you need is a low-fee anchor, something that gives you long-term exposure to the giants actually driving market returns. SCHG is built for exactly that. It focuses on U.S. large-cap growth names with strong fundamentals and momentum. We're talking Apple, Nvidia, Microsoft, Google, Amazon, the mega-cap killers. And the numbers back it up. In the past 12 months, SCHG returned 17.62%, while keeping costs microscopic at just 0.04% in fees. Zoom out a little. Over the last 5 years, SCHG has outperformed the S&P 500 by nearly 30% cumulatively, while maintaining lower downside volatility during market corrections. Imagine a line chart. SCHG in blue, S&P in gray. SCHG isn't just tracking the market, it's outrunning it. So what's the move? Use SCHG as your portfolio trunk. It gives you exposure to high-conviction mega-cap tech, filters out the noise, and holds steady when things get choppy. If you want upside without waking up to panic emails, this is where your core belongs. Let's clear up a myth right now. Triple QM isn't just another tech ETF. On the surface, it may look like it overlaps with funds like SCHG or QQQ. But under the hood, it's built for precision. SCHG gives you strength. Triple QM gives you speed. This ETF tracks the top 100 non-financial companies on the NASDAQ, meaning it's laser-focused on the true market movers. We're talking Apple, Microsoft, Nvidia, Meta, Amazon, names that don't just participate in the market. They move it, and the performance proves it. In the past 12 months, Triple QM returned 20.42%, with an expense ratio of just 0.15%. It's not cheap, but it's lean. That small fee buys you exposure to a streamlined portfolio that's built to run hot when tech is running. Let's break it down with numbers. Compared side by side, Triple QM holds fewer names than SCHG and is far more concentrated. Volatility? Slightly higher, but so is the upside. In a normalized growth cycle, Triple QM has historically outpaced SCHG by 3 to 5% annually, while maintaining exposure to the same core players. So here's the move. Use Triple QM to scale your tech exposure without needing to babysit a dozen individual tickers. It's like handing the keys to a precision-tuned Tesla and saying, drive. If SCHG is your foundation, Triple QM is your rocket. Or let's make one thing clear. Owning tech stocks doesn't mean you own innovation. A lot of investors load up on big names and think they're covered. But the reality is, true innovation isn't just the face of tech. It's the infrastructure behind it. And that's where the Vanguard Information Technology ETF is not a hype machine. It's a streamlined portfolio of the companies actually building the digital economy. Cloud providers, chip makers, software architects. We're talking Apple, Microsoft, Nvidia, AMD, Oracle, and more. The engine room, not the showroom. In the last 12 months alone, VGT delivered a 22.95% return with an ultra-low expense ratio of just 0.09%. That's serious upside with minimal drag, which is exactly what you want when compounding over time. Now let's back that up with some context. If you compare VGT versus QQQ versus XLK over the past 5 years, VGT has outperformed both on a KGR basis, returning 15.8% annually versus 13.4% for QQQ and 12.9% for XLK. Why? Because VGT goes deeper into the infrastructure, the hardware, software, and data systems driving the AI economy forward. So what's the play here? Use VGT when you want high conviction exposure to tech infrastructure. Not just the names in the headlines, but the ones actually building what comes next. This isn't trend chasing. It's trend building. Everyone talks about AI like it's just ChatGPT and smart assistants. But here's the truth. Apps don't drive AI, chips do. Without the hardware, none of this innovation works. That's where SMH, the VanEck Semiconductor ETF, comes in. This ETF is pure concentration. It gives you direct exposure to the companies building the physical backbone of AI, the factories, the fabs, the silicon. We're talking Nvidia, AMD, Taiwan Semiconductor, Intel, Broadcom, and more. The names that make innovation possible. And the results speak for themselves. Over the past 12 months, SMH returned 39.62%, nearly double what most broad tech ETFs pulled in. And here's the kicker. Over 75% of its weight is in the top 10 holdings. That's intentional. It's not trying to be safe, it's trying to win. Picture a pie chart. Heavy slices for Nvidia, TSMC, and AMD. Now, line that up next to a performance graph of SMH versus Nvidia stock. You'll see SMH follows Nvidia's trajectory, but with slightly smoothed volatility and broader coverage. That's how you get leveraged access to AI's supply chain, without going all in on a single name. So if you're serious about the hardware layer of the AI boom, SMH is your vehicle. This isn't diversification, this is targeted acceleration. Let's talk about the ETF that most people skip, and regret skipping. It's called CHAT, the Roundhill Generative AI and Technology ETF. And here's the real problem. Most investors obsess over fees instead of focusing on net return. Let me show you the math that makes that mindset a mistake. You put $1,000 into Triple QM, a solid ETF, and over the past year it gave you a $24 gain. Not bad. But if you put that same $1,000 into chat, you'd be up $519. That's not a typo. That's a 51.93% return, even with the higher 0.75% expense ratio. This is where people mess it up. They'll save a few bucks on fees and leave hundreds of dollars in gains on the table. It's like tripping over dollars to pick up pennies. Now, let's visualize it. Imagine a bar graph with chat, VGT, QQQ, and SPY. Chat towers over the rest. Nearly 3 times QQQ, 2 times VGT, and over 4 times SPY's return. Why? Because it's concentrated, aggressive, and laser-focused on the companies building, scaling, and monetizing AI globally, not just in the US. This ETF isn't a hedge, it's a hammer. And if you believe AI is going to reshape industries from search to surgery, then chat is where you plant that conviction. Use it when you want aggressive, momentum-driven exposure to AI's front line. So how do you bring this all together without overthinking every move? You stack with conviction, not confusion. No random picks. No overlapping for the sake of diversification. You use each ETF like a tool in a system. Each one has a purpose, a role, and a reason to exist in your portfolio. Picture a flowchart. SCHG is your base, your anchor in mega cap resilience. Then you scale with triple QM when you want precision. You tilt toward innovation with VGT, go deep on hardware with SMH, and hit the gas with chat when you're ready to chase real velocity. This is what I call structure with teeth. You're not hoping, you're executing. Now here's your mindset toggle. Imagine this works. Imagine these 5 ETFs anchor your portfolio, grow it steadily, and catch the upside of the most powerful economic shift since the internet. Now flip it. Imagine sitting out AI again. Imagine watching tech soar while you cling to a model that made sense in 2005. And this isn't just theory. Let's talk Brandon, a guy who used to panic sell every time the market dipped. After applying this exact framework, he cleared $74,912 in gains just by holding the right mix, riding through noise and sticking to conviction. So here's the action. Stop chasing hot takes and gut calls. Start building with data, structure, and a system designed for how the economy actually works now, not how it used to. If you've made it this far, here's the bottom line. Follow this and you'll avoid fragility while compounding future-proof gains. That's what the Basket First Plus 5-moat satellite system delivers. Not hype, not guessing, just structure that holds through chaos and scales with conviction.